what seems to be a disconnect between Wall Street and Main Street. But I think that maybe might exaggerate and misunderstand the way the markets work. What the key to people buying stocks today is not what's happening today, or what was happening yesterday, but what's going to happen in the future. And I think the prospects of a vaccine has really lifted what we'd say the animal spirits. And so I think that with the prospect of the vaccine, I think that's helped lift the stock market even higher than it was before, even though now it seems like there's maybe a little bit of rotation, so that a broader part of the stock market is rallying. So for example, this month of November, the Russell 2000, which is a broad measure of the US stock market, is outperforming the other benchmarks like the NASDAQ or the Dow or the S&Ps. And what this shows perhaps is that with the prospects of a vaccine, people are getting interested in value again over growth. And partly what this means in Asia is that we've seen the Asian equity markets as a whole, the whole region, really rally here in the month of November. I think there might be 2 days where the MSCI Asia Pacific Index this month has actually fallen. And probably the most, the international equity market that's seen to be the most value is the Japanese stock market, because some of the major indexes there, like the Nikkei, the stocks may be trading at like half of, say, the book value that they do in the U.S. That price to book value is an important metric for some equity investors. And Japanese stocks had looked like they've been underperforming for many years. And so once we got a whiff that a vaccine was really possible, we've seen the Japanese stocks take off. Yeah, so it's true that it's taken us a while. This is a very unusual election for the United States, and it does seem that it's increasingly, I think the current administration recognizes this, and the transition process proper has begun. It is true as well that the Democrats and President-elect Biden have argued in favor of a larger stimulus package. We really won't know what's possible until we get a little bit into January. And January is important because we have every state has 2 senators, and Georgia has 2 senators where the election was so close that they have to have runoffs. And because the rest of the country is so evenly divided, the Senate itself is up for grabs depending on how these 2 Senate seats get selected in early January. And the Senate is really the key, as we've seen in recent years. The Senate becomes the key to whether you can really get as aggressive of a stimulus package as the House of Representatives wants. And if the Democrats lose control of the Senate, if they don't get control of the Senate, right now they don't have it, but if they were to fail to get it, I think that this would seem to be tempering what President-elect Biden can do. On the other hand, one of the interesting appointments, and for the first time in American history, we're going to have a woman at the head of the Treasury Department, Janet Yellen, the former Federal Reserve Chair. And she also has been arguing in favor of a larger fiscal stimulus, like the rest of the current Federal Reserve. And so with somebody like her at the Treasury helm, I think we'll see greater cooperation with the Federal Reserve. But also I think that we've seen the executive power's discretion and the kind of things that she could do to help stimulate the economy just purely as Treasury Secretary. So I do think we should expect some fiscal stimulus early next year. Inflationary, I think, is a different story. I think that where we are seeing inflation right now seems to be coming from commodity prices. Copper prices are at multi-year highs. The grains like soy and corn are also very high. Iron ore prices are high. And partly this is that same thing that we were talking about before about the prospects of a vaccine and how people are anticipating stronger growth in the world economy. But at the same time, it looks like most of the demand is coming from Asia and especially China. As China's economy expands at an accelerating pace, the need for soy and corn has skyrocketed, and of course copper as well. And so I think in general, the rising commodity prices reflect stronger demand really stronger demand from China, but anticipated stronger world demand. But the stronger commodity prices doesn't necessarily fuel inflation. You think about the cost of the inputs and the raw materials for an input, whether you're making a good, like a machine tool, whether you're making a pot and pan, the raw materials are a relatively small amount of the final cost of production. Most of those other costs of production, labor costs, transportation, storage costs, marketing costs, all those lawyers and bureaucrats that we have to hire. And so what we find really is that there's become like a decoupling, if you will, of raw material prices and finished good prices. And that's what profit margins absorb, expand, or have to shrink. And so in my work, I'd say that one of the key things for large U.S. companies is what we call translation. And that is when they make their overseas earnings, how those earnings are translated into dollars, which is how they report their earnings. And so this translation should be for U.S. multinationals, given the dollar's recent, say in the last 6 months or so, dollar's recent weakness. So I think that's a positive thing. And also I think to keep in mind that of course, with this pandemic still like we might not have seen the worst of it in the United States. There's some signs that Europe is beginning to turn the corner, and that just means that we're probably in the U.S. a tough winter, maybe even a tough early part of next year, regardless of what happens with the vaccine. In the short run, this isn't really good news because it means that the worst of the pandemic, we still have to feel that, and with the health issues and the deaths that's going to happen as well, and how long businesses are going to be curtailed. But what I think this means in the medium and longer term is that we should expect a much stronger second half of 2021. And I think that will continue to excite investors. And I don't think that we're going to get central bank rate hikes in the US, Europe, or Japan. And that means that there's still going to be cheap money, low interest rates, and nothing else for savers to do but buy stocks. And gold has had a very tough ride. You'd think that for a while gold and the stock market were correlated. And now the stock market continued to go up, gold goes down. And then it was the fact that when the dollar was strong, gold would go down. The dollar's been weak, and gold still has gone down. We've approached a very important level in the spot market for gold, $1,800 an ounce. And that's an important level because that's about where the 200-day moving average comes in. And people in the markets use the 200-day moving average as like a mile marker. Imagine that you're a person that's been wanting to buy gold, but it's been too high. It was at 20.75 3 months ago. That this is too rich, that's a record high. And so you wait for a pullback. And this is the pullback that we've had. We've had about a little bit more than a $200 pullback, and we're testing that 200-day moving average. I suspect we might go through it a little bit. But this is the kind of pullback in markets, especially if you're predisposed to be thinking about diversifying investments into gold. This is the kind of pullback many people are waiting for. And so I would suspect us to begin finding support. And once we find support, those people who don't like to be the first ones in will see that support, will see other people are buying, and then they'll come back in. So I'd be watching for gold to stabilize, even though it's been in a tough ride for the last couple of weeks.